you're not needing to have a double-digit return. You may want to, but you don't need to. Welcome to the Make Your Money Matter show. I'm your host, Brad Barrett. Today we're gonna be talking about the 3 things every portfolio should have in it. I don't care if you're a beginning investor, an experienced investor, you got a small balance, big balance, doesn't matter. Every portfolio should have these 3 things in it. Before we get started, make sure to hit the subscribe button, hit the notification bell, make sure to never miss a show. Let's get into it. Let's have a setup here before we get into the 3 things every portfolio should have or consider when designing your portfolio. First and foremost, you want to grow your account, right? Everyone does. You don't invest to lose money, all right? So you want to look at growth. Number 2, you want to look at protection. That's important. So growth, protection, and then ultimately the use of your money, the distribution. I talk heavily about planning around the accumulation phase, ultimately the distribution phase, but that's the framework we want to go through. Growth, protection, distribution. So for the first topic around investing for growth. Now, unless you can save all the money you'll ever need just by cash savings, you'll have to find ways for your money to grow. So over the long run, you'll look at just historical data of stocks, which many of you have before, and you'll see they've done the best job of producing that growth. Now, there's a graph I want to show you here that we've actually designed. It's a recent one that we just updated as to the end of 2021. Now, for many of you who've seen this, you've probably seen this before, but it's a good note to look at here when it comes to how stocks in particular have far outpaced bonds or cash. So in the category of growth, number 1 is find equities that you want to use in your portfolio. That's number 1. As you can see here on the graph, stocks have performed 9.7% annualized growth between 1927 and 2021. That's a decent time period. So it's important to know. Now, I've spoken before about intra-year declines, things like that. This is throughout. So remember, it's not time in the market, it's time in the market. It's very important, okay? So the use of ETFs and individual stocks that are all researched and developed, something we do here at our firm or through our investment committee, really have a lot to do with how we are looking at the one main area of growth that every portfolio should look at. And you want to have a good balance between what we consider value and growth. So when you talk about equities, you want to look at value and growth. And in general terms, a value company is a large established company. Think Procter & Gamble or Johnson & Johnson or something like that. Established company, they provide a dividend typically. And a growth company, in the inverse, will somewhat be the opposite. They're still in growth mode. So the earnings that they're making, they're essentially mostly reinvesting it back in the company. Now, Apple used to be my great example. I think a lot of us call it our pocket investment. We all have either a MacBook or an Apple if you're an Apple user. But they used to be heavily a tech growth company until a few years ago, they actually instituted a dividend. So they've kind of shifted away from growth to value, but it gives you a good example, if you will, between the difference when you talk about equities, one of the main things you want to look at in a portfolio around growth versus value. Now, these companies like Apple or others have given investors big growth, and they did it by innovating and giving their consumers or their customers, people like you and me, what they wanted. As long as they keep doing so, they should continue to grow. Now, obviously, firms like ours managing nearly $4.5 billion for clients, we have an entire investment committee chock full of chartered financial analysts looking through price to earnings multiples and all the fundamentals around it. And our team is always doing that. We want to find good earnings, good multiples, and understanding that we want to build a portfolio from a risk tolerance perspective for each of our clients. So as you're listening and watching here right now, you really want to find an advisor that wants to sit with you and listen to where your risk tolerance is. Because when we talk about growth being our first pillar here of a portfolio, you want to have growth relative to your needs. Back to planning. I know everyone's probably bored of me saying it, but why it's so important is we talk about rate of return so much, but the younger brother to rate of return that deserves just as much love is the distribution rate, something we talk about for our clients looking to retire. Understanding your distribution rate has a lot to do with how you want to manage your portfolio. If you have a distribution rate, say of 2%, you may not need to go out over your skis on growth. You may want to find more value, more steady growth. You may not need to be investing in small cap or micro cap companies because you don't need that kind of growth, but you may want it. So it's really important to talk that conversation through from a tolerance level around growth, because understanding your risk tolerance, if you haven't looked at that yet, is important, because we want any good manager, really for us, I can only speak for us, should tailor a portfolio to fit those three basic needs of growing into this. And ultimately, growing and relating to distribution and protection comes into having a diversified portfolio globally, I should add. And something we do here at the firm, globally, multi-asset class investing is important for a well-rounded portfolio. And the growth side of it comes from having strong companies and owning those individual stocks that you like in some of the large cap areas. Now, I want to give you an example of what this might look like. So let's put this up on the screen here for example. What we're showing here is investment philosophy and investment strategies. And I bring this up because for us, investing takes time, and the mindset is looking out on the horizon for what's coming and how to take advantage of systemic movements really in the global economy. And from there, I think when you really look at that, a strategy rises and must be consistently applied to succeed. That's that discipline I talked about. Be it, again, value or growth, something we just talked about, or in our case, when it comes to a diversified portfolio, and that's, by the way, into the second pillar here around how you protect your assets. So we talked about growth, looking at equities, seeing how they have outpaced markets, have outpaced bonds, T-bills, cash, as we all know, over many, many years, right? The second phase here, when you talk about protection, for us, it's around diversification. And so back up to that slide for a second. When you look at a multi-asset class, tax-managed, risk-managed portfolio, and you marry that with the investment strategy, whether it's value, growth, and for us, a blend of the two, which is really when you get in diversification. And in the end, price will always determine return. My grandfather always said this. He said, you always make your money on the buy. And if you think about that, if you do your research right, you'll be able to hit the first pillar of what everything should have in a portfolio, which is growth-oriented positions. And secondarily, if you have it diversified, which is what we're talking about as the second pillar here, right? You have it as well-organized, well-diversified, strategically placed, and you are fundamentally buying good value, because again, in the end, price determines return. So the third thing I want to talk about, and the third pillar of a portfolio, has to do with ultimately the distribution. Now, the third pillar will actually pick up on the first two, right? You still want to grow the account. You still want to protect the account. That hasn't changed. So these are basically a culmination of each other. And the third thing when it comes to distribution is twofold in my mind. One, back to planning, is really understanding your spending as a percent of liquid assets. What do I mean by that? If, let's say, as an example, you have $1 million in your IRA, 401k, 403b, TSP, whatever retirement assets you might have. And by the way, they don't have to be retirement assets. They can be trust assets, brokerage account, whatever it might be. Let's say in my example, hypothetically, you have $1 million saved up. After Social Security, maybe a pension, maybe some rental income, whatever other income sources you have, you still need $30,000 to live on, okay? $30,000, it has to come from somewhere. It's not coming from your income anymore because you're retired or you're living financially free or living off of your savings. So ultimately, the quick math is $30,000 divided by the $1 million you have saved. That's 3%. All my math people out there, you can check me. $30,000 divided by $1 million in a hypothetical example is 3%. That right there is so important to understand when you talk about growth and you talk about protection. Because when we talk about growth, again, back to my point, we're in that example, you're not needing to have a double-digit return. You may want to, but you don't need to. By the way, just understanding that right there as a plethora of stuff to talk about when it comes to a conversation with a client or in a discovery meeting around how we be in managing and investing a portfolio. So when you think about the ultimate distribution phase of this, the first thing we want to look at is understanding your distribution rate. From there, we pick up on the first two pillars of finding growth, finding value, right? And ultimately how we protect that income stream thereafter. So a part of that is the use of dividends, fixed income, and the like. It's really important for us to go through how we want to structure the environment when it comes to a portfolio that ends up going from the contributory phase to the distributory phase, if you will, right? Because for years, 30, 40 years, you are working and saving and contributing. then ultimately when you retire or choose to live on your savings, you will stop the contributions and you'll ultimately start the distributions. And that's where you focus on that third pillar of making sure that your portfolio stands the test of time to weather the distribution phase. So number one is growth. Find equities, find things that have outpaced inflation, have outpaced other asset classes. The one thing we look at right away is equities. As you can see from the performance numbers, they matter and they should be involved. They should look at it. It's really up to you and your advisor to make sure you go through the right equities, value, growth companies, ETFs, and what you want in your portfolio. But growth is number one. And number two is protection. And the best way to protect the growth and the value you're having in your portfolio is through diversification. Actively managed, rebalanced, and diversified. That way you have in an economic environment, when something goes down, you have something else in your portfolio that goes up. I know I'm saying basic things here for many people, but I wanted to give the framework of all things you look at. I can't tell you how many times we get a portfolio from a client who's called in from the radio show or from the podcast around, hey, Brad, here's our IRAs, here's our 403Bs, here's our 401Ks. Can you take a look at it? Let us know. And we run a plan for them. And we go through the distribution rate. First and foremost, they always say this is way more in depth than we've ever had before, which is a good thing. So I want to share that with you all. But the reality of what we talk about is we actually go an in-depth study on their investments, of what they have been investing in. And before I say anything, I typically ask them how they want to be invested. What is their mindset? It's like, well, Brad, I'm pretty conservative. Like I don't really want market risk and I don't, this, that, and the other. And to be honest with you, 9 times out of 10, that might be a stretch. Majority of the time, I should say, that the equities that we're reviewing or the accounts that we're reviewing tend to be highly skewed towards growth-oriented investments. And the clients are like, wait a minute, that's not what I wanted. Although they're probably happy with the returns, that's not what they had in their head. So when we understand fundamentally how you want to be rebalanced, how you want your portfolio to be structured, ultimately gets into the protection you are actually looking for when it comes to your portfolio. And then finally, the third pillar we'd focus on is making sure that we have it built and structured for you, or you have your portfolio built and structured so that you can ultimately take money from it while also not touching principal. So the 3 things we talked about today around the pillars, I should say, of what every portfolio should at least discuss and look at. Many of you watching right now and listening actually have these in there, and then you drill down into what you want in there, but growth, protection, and income. And I think it's probably important to kind of go through this, and it's a broken down version, but I like this and how I've described it to clients for nearly 20 years, right? There's really only 5 places to invest in this world, if you really think about it. I don't care who you're watching. They got some pinstripe suit on. They got a bunch of letters behind their name. The reality is there's 5 places to invest in this world. There's cash, that's cash in our pocket, CDs, money markets, cash in your backyard, buried in a hole. That's just cash. 2 is fixed income. By the way, this is not any order, just in general terms. Fixed income or bonds. That can be municipality bonds, government bonds, corporate bonds. 3, equities. We just talked about that. They can be ETFs, individual stocks, mutual funds, but anything invested towards a public market, if you will. Now, obviously underneath there can be certain things like private placements and other things, but just growth-oriented areas. 4, commodities. That could be oil, gas, beans, corn, gold, silver, commodities. And the 5th and final one is real estate, whether that's your primary home, rental property, corporate land, raw land. You know, you look at those kind of things. When we talk about a diversified portfolio, our job as good portfolio managers is to make sure that you have exposure to all of those areas. So when something goes down, something else goes up. And so focusing on the basics when it comes to the pillars of what a portfolio should have and really what you should look at when it comes to investing, I wanted to touch on a few things today. I thought it'd be wise for us to at least go through. So I want to move over to the part of the show where I answer your questions. And if you have a question or topic you'd like me to address, you can leave a comment or question in the comment section below. Or if it's something a bit more personal or you want to talk one-on-one, just go to the About page on this channel and send us an email. We'll always keep the questions I read here anonymous, so you never have to worry about your name being shared, but we'd love to hear from you. Again, you can leave a comment below or on our social media channels as well. And the question today is, what percentage of my retirement should be in bonds versus equities? Now look, again, it's an art, not a science. That's the discovery we'll go through and make sure we fit the investment portfolio with you. But I want to help at least answer some rules of thumb that are out there. You know, back in the day, or actually many people today even think that as you get older, you should get more conservative. there used to be a rule of thumb, like whatever your age was is what your fixed income exposure should be. So for example, if you were 20 years old, you should have 20% of your savings or investments in fixed income and 80% in equities. And as you go up the scale, if you're 80 years old, you should be 80% fixed income and 20% in equities. That's a rule of thumb. I'm not saying that's right or wrong. That's what's out there, right? Here's the point I'm trying to get at is, ironically, when you look at fixed income as a perspective, speaking of that for a second in terms of how much your allocation and portfolio should be, you want to be careful, right? Because right now, for example, we're in an inflationary time period. So when you have a rising interest rate period. So when you have rising interest rates, your bond prices go down. It kind of works like a seesaw. Rising interest rates, bond prices go down. When we have a decreasing interest rate environment, bond prices go up. So if you think about that, for example, we want to be careful of the duration, how many years out you go in your bonds. So just quickly flipping over to, hey, I'm 80 years old and I want to just go conservative and have 100% fixed income, you really want to make sure you suss that out to make sure it's the right move for you based on growth, income needs, and overall value, past 2 or 3 years. So there isn't a right answer, sadly, on this. It's more of, again, an art, not a science, but it does have to do a lot with the distribution rate. I can't stress that enough. Understanding what you are pulling from the portfolio and then ultimately what your goals are with the assets. And really at that point, we talk about legacy assets, who you want to leave it to, how much you want to leave it to. Do you have legacy asset goals? So there's a lot that goes into that answer, but I guess what I want to answer is the rule of thumb is out there to kind of understand that. And then the terminology, I guess I would say, between the adjectives of labeling yourself a conservative or an aggressive investor, in my opinion, in 20 years of being in this business, that's largely the financial services world of a marketing tool to kind of put you in one of those camps. And the reality is I don't think everyone just fits into those. And I think it's really important to go through a portfolio design that actually fits you. So again, if you have a question or comment you'd like me to read here, leave it in the comment section or email us, again, on the About section on our page. Now, before we go, if you found this show helpful and want to learn more, you can visit our website. It's up there on the screen, or give us a call. We want to help. Listen, there's no pressure here. We don't treat people like a number. In fact, we value relationships. It's the lifeblood of what we do. So click, call, or text us today. And if you're not following us on social media, you should be. We're sharing great information on all of our social platforms. More than anything, I want to thank you for spending part of your day with us. And remember, as I often say, if you enjoy the show, share with someone you like. If you don't like it, I guess share with someone you don't. But until next week, always remember, make your money matter.